Hi everyone. So thank you for joining in on the space today. The topic for the day is if you see the unusual volatility and survival with the being in a bracket. I thought, and this is largely inspired, I think, from the book by Benoit Mandelbrot. He talks about misbehavior of markets. It's a book, so he's the one who has coined the term fractals. And being trading various systems and seeing markets over a period of time, and where we see volatility is is always mean reverting eventually, the way it currently has also kind of we saw from a low vol it has exploded. So I thought of putting this topic, and we just got thought of sharing some thoughts where Amit raised something in a group that why don't some of us come and share. Now, one of the thing obviously I missed, which he mentioned, was that can experts share? And if I had kind of seen that, I would probably not have taken the lead, because I'm still a learner, and there's so much to learn every day. But I just thought, why don't we share some of our thoughts and ideas, and especially with a lot of systematic traders who have been sharing on Twitter of late. And I saw that various people are going through various phases in their strategies, right? In their how their equity curves are behaving in this kind of environment. So just to set a little bit of the context from my end, I'll share a little bit of background of what we do and how I think we may tend to probably survive this. And again, there is no right and wrong answer here. There is basically just some methods or ways how different people deal with it. But I'll just share how we think, how we are going about it, and then we'll be very happy to have the other speakers come on, share their thoughts, and then leave it to Q&A, or even others from the audience can come in and just request to speak, and as many people as we get a chance to speak, we can speak. Basically, running systems where starting with momentum systems or trend following kind of systems, and gradually we started moving on to running non-directional strategies as well. And what we have seen is basically the directional strategies obviously will have their limited share of win rates. I mean, basically, they will work when markets trend, and like recently you could see that there are some kind of overnight trends which we have seen which have developed well. Now, if you look at some intraday trading systems, well, different systems may have gone through different phases and behaviors in the recent vol. Some may have worked, some may not have worked. And along with these kind of trending systems, which do have their share of drawdowns and volatility in the equity curve, which is the challenge for any trend follower, they will tell you that. And if they don't get drawdowns, I can tell you on upfront that they are lying. If somebody doesn't get drawdown in trend following, he or she is a liar, when there is absolutely no doubt about that. So how do you deal with these drawdowns is to different ways. One is you can kind of minimize your allocation on these, like, so you run a certain size of money. Two is what we do is we run some non-directional strategies also, right? And again, they also, different strategies go through different phases of volatility. Like we just saw one of the system go through a volatility recent time. But along with that, we are the directional strategies which we run, which are positional as well, right? They have tended to do well. So we think the way the volatility has been in the last few days is just probably sample of what may remain for a while. It could, if things cool off, it could cool off. But if things develop further, it could worsen. Nobody knows. But when you trade, we trade systems, we have to be prepared thinking that anything can happen, right? So rather than running one system, in short, it is always, it's more prudent to run a basket of systems which are all complementary, very similar to like a cricket team with different players with different skill sets. So maybe like you have a right hand batsman and a left hand batsman and a a spinner as well as a fast bowler. So that whatever kind of pitch you get, right, the team tends to survive and do well. So very similarly, when we run these bouquet of systems, uh, one of them, the main one which we run called Phoenix for derivatives, has got has got long short stock strategies, non-directional index option strategies, and directional index strategies. And whilst individual strategies of these may go through higher than normal drawdown periods, we have seen that this basket as a whole tends to kind of uh, adapt in some way. And obviously there is no solution it has arrived at, sort of, where market is constantly changing and evolving. So we have to keep learning and keep upgrading. But basically we try to keep running these multiple systems together. And then along with, I think, the types of strategies, I think what is also very important is the weight or the leverage that you put on these systems. Because how do you decide how much money to put on which strategy? Right? Is it a mathematical answer, or is it something that you're more comfortable with? Like if you find a certain style of trading more comfortable, then you allocate more. Or is it more also on the needs of clients, that if some of you serve, in terms of what they want? So how you sort of mix and match that is also something very interesting, and poses different kind of challenges to different kind of traders. So having said that, I would like to have maybe some other speakers who are trading systems, share what they are going through in this kind of phase, how they how they are adapting, or how they look at this kind of system. It's also going to invite some more people who I think may be able to share their thoughts. And Yogendra, if you'd like to speak. So okay, I'll also invite some of the other traders. You could kind of be trading systematically or non-systematically. I mean, you may not be doing total mechanical, but you use some set of rules. uh, you know you could sort of come and share your thoughts. So we have DJ Kara, I think.
Hey Vivek,
DJ,
yeah Vivek, my name is
hi.
Dheeraj. One thing I have noticed over the past few years that market has gotten very volatile, and I think one of the primary reason is that now everybody has access to a lot of data. Everybody is looking at option chain, where are the max calls being written, and so on. So in order to get money from the retailers, the stop losses have to be hit. I remember a few years back, you could just look at the option chain and say, you know what, Nifty is not going below this month, and it's not going above this number on this month. But that all changed now. It's just impossible to look at data and say uh, I'm going to trade in this range, or I'm going to sell these options. It's become a much more difficult game now. And personally, I just hedge everything. I mainly do option selling, and I just hedge everything. And I've been able to deal with the volatility. Uh, um, my profitability has gone down. It's more adjustments are required, but it's not something that's not doable. And I think the
Right. So
volatility is
how?
going to stay as long as the more data people read, the more it's going to be, the more difficult things will get. So, we have to be prepared for prepared for this, for the years ahead.
Right. So anything in particular you find different, Dheeraj, in these last few days than what you've been doing usually?
Yeah, it's, as the VIX suggests, it's very volatile. Uh, I would have preferred to just not do anything this month because, you make a profit somewhere, lose it somewhere else. It's a lot of effort just trying to remain in green. And I would just prefer to, come back into the market once the VIX is below 25. But then I don't know when that's going to happen. And I got to learn how to deal with the volatility also. So that's the reason I'm trading in these conditions as well. Otherwise, I would have preferred for the VIX to be below 25.
Yeah. So that is
Yeah,
always a dilemma or a question because in a way there is opportunity as well, but
correct.
it comes with its share of risk. So do you, if you don't participate and you're only you kind of don't get that VIX regime below 25,
Yep.
then what do you
Yes.
uh,
Yes. I think
what
we
do you
just
do?
have to get used to
So
the volatility. Where now everybody has access to all the information in real time. The big players no longer have any, advantage over information. So I'm expecting the markets to continue to be volatile for in the coming future. So
right, and do you hedge your short trades, short option trades, or do you just do them if they're overnight or if they're intraday? You
I,
also, how do you manage risk?
if I'm very confident, I take a naked trade and then hedge it later once it comes in a bit of profit. Otherwise, uh, off late, I realized it's better to just hedge everything the moment you enter the trade. And, uh, and another thing here is you can't hold your trades position as an option seller. I usually would wait for a couple of weeks to book my profit, at least hold the trade for 2 weeks. But now with these whipsaws, you got to book early, which means your profits are smaller because you haven't got an advantage of the full decay in premium. So need to take more trades, less positional, and yeah, I'm just hedging all of them. On the short side,
Right.
I'm not hedging, but on the long side, I am.
Okay. And Dheeraj, do you also adjust your size of trades that you do normally in such kind of volatility?
Size. If I feel I'm in the right direction, I'll probably add. But it hasn't been working out because the market's just all over the place. So one has to keep their position sizing also limited. So calculate your risk, do your position sizing if you're adding more positions.
Yeah, that's one of the ways which obviously in a regime like this, which many people suggest, many people who have survived and lived on as traders for years suggest that when your volatility goes up, you may want to reduce the size of the position of the trade.
Correct.
Right. So generally, it's whether it's if it's one technique, you do that, and obviously selectively, like as a discretionary trader, if you find something has been working for you, you may want to add on to it with experience. But generally, if you're trading mechanically, you want to kind of reduce the size. And the other way you can deal with this challenge is to then run multiple types of systems again with smaller sizes, which together then uh, you know hedge each other sort of and provide a overall probable survival approach.
Correct.
So different traders tend to use. different types of approaches.
Yes, that makes sense.
So, so fantastic. Amar, would you like to add on and share your thoughts? How?
Hi, Vivek and everyone. I think Vivek, you added me as a speaker by mistake because I'm an absolute novice when it comes to volatility, options, and all of these uh, academically oriented things. So I'm really not the best guy to comment, but I can see some legends over here in the listeners. There's Prashant, there is Ankit Garg. I think I would love to hear their perspective. As
Amar,
long as
believe
I'm
me,
concerned,
we are all learners, and I think
I
if there is anyone who's a legend, it is the market itself. So we are all
yeah, yeah, I'm
contributing.
sure there is Kirit sir also there. So I think I mean, more experienced and much smarter people are here. So I would be a happy listener. And as of now, I'm only an investor in in your systems, which I'm happily experiencing the drawdowns and the equity curve. So yeah, I'm just here to learn so much more about this huge game, right? So I'm again adding myself as a listener from
Uh,
the speaker. So
So,
yeah, please.
Amar, you are very experienced dealing with a lot of clients, right? And it may not necessarily be purely in equity space, like you have experienced a lot of clients in debt and these kind of space. So,
Yeah.
how is general investor behavior in the last few days compared to say the last few months? And are there any? How's that?
Oh yeah. So I think these are unprecedented times in terms of volatility and drawdowns. And the funny part is this was happening after 18 or 24 months, where a usual HNI investor kind of took 12 to like 17-18% returns for granted. And this is really a tough time from an investment like from a person who is managing those relationships from that point of view. I deal with several UHNI clients, who actually, what happens is this is very, very human behavior. I think Kirit sir can probably add some insight in this. But as you keep getting something, you kind of take it for granted, right? So markets were pretty kind to all the Zerodha investors and to the UHNIs at the same time, on the long side. And this also the huge new crowd of selling options and making decent amount of ROI on a monthly basis. So I think this has come as a very crude shock to everyone that okay, markets can be unkind too. And I think we are pretty much aware after spending some time in the markets that okay, this is bound to happen. It's not a shock actually, but it's a kind of cycle which has kind of it's on its usual track. And so, from a client's perspective, I think it's really important to set the context, which we always do. If you remember, we've done discussions with a lot of people, and while the going is good, we actually set the context that what a very tough time can also come, but you need to brace yourself for that. So, it's actually more important to do this discussion during the merrier times, because right now when you lose money, there is a lot of chemical reaction that goes in your mind, because it is something that we love so much, and we can lose it ourselves, but we cannot have anyone else lose it for us. So when Dravyaniti is managing my trading portfolio, which I feel supposedly should do a 25% CAGR, and suddenly if I see a drawdown of 10-12%, it is bound to impact psychologically. But if the context is set right, then probably, and if I have enough faith in the systems, I think I am someone who will be looking at topping up my exposure to a system which is generally facing a max drawdown right now. Again, this is extreme behavior. I don't consider myself as correct in this, but the way HNIs are currently thinking is exactly the inverse. And you will see a lot of redemptions coming in PMSs, alternative investment funds, and the likes of algo trading, the managed futures accounts. So yeah, very tough times, but setting context is, I think, the only missing piece. Over to you.
Thanks a lot for sharing that. I think what is very interesting is always when the vol is very low, which was for a while. We kind of tend to think, or we know that there will be a high vol environment, which as a whole generally tends to work for systems, but obviously they have their patches of probably also witnessing higher volatility in the equity curves before capitalizing on the return that the high vol can present. But I just find it very interesting how we already know about it somehow, but when it comes to implement it practically, right? How many people actually believe or take that into account as even investors in their decision making? Because, like you said, when the going was good, most people had, we were thinking that. Uh, and I would say we are party to that as well in a way, because when markets were going up, a lot of people were leveraging their equities and mutual fund um, portfolios to take margin. And now with a little bit of kind of a jolt there, I mean, it affects your portfolio value also. And then if the haircut increases, right, and your system is in sort of a drawdown, it poses some sort of a challenge. So it's always interesting how we see these cycles again and again, and how we behave. But I'd like to probably ask Prashant to throw some light on how he's living through this time, man.
Hey Vivek, thanks a lot. Just upfront, I just want to apologize if my stream just breaks off, because I have issues with Twitter Spaces off and on. I think I just want to touch upon one point that I think it was Kara who was making this point about VIX being high, and then you talked about it a little bit as well. I think a lot of systems tend to get designed with features that are that have a bias to the period that they were tested on. And so what I mean by that is that when you design a system using data from a period where your, say, volatility has been on an average somewhere around 15, 16, 17, you know a wall of 25 can be high, right? But we don't know whether that long-term average of 17 wall is actually going to be the average, over the next 5 years. And it very well could be that we are approaching a norm where you could have realized volatility and then hence implied volatility creeping up into the 20s and so on. And that's something that we I guess we have to be aware of, that we tend to get biased with what historical data that we have available, that a lot of people tend to either design their systems on or benchmark their performance on. So that's one thing, right? We don't know what the future realized vol of the market is going to be. And when the market transitions from one regime of vol to a different regime, there is always going to be pain, because a lot of people who are attuned, or in terms of their risk taking abilities or strategies that they've been deploying, are attuned to these different vol regimes. And so I think that will take a little bit of time for that to normalize. Eventually, what will happen is, think about it, for the next year, if you have a vol regime that is averaging 25 vol, then you will have adjustment of a lot of these strategies towards that vol regime. And so your back tested systems, your group of strategies are always going to be in some ways following the market that has just gone by, right? So that's just my view of things. And I think that this is the piece that when a lot of people talk about being adaptive to the market and not doing something foolish where you are risking too much and then not being able to survive in the market, this plays a role where you have to be nimble about how you approach your strategies deployed in the market.
So
One last thing on. I'll just finish that point because I don't know when I'll drop off. But the other part of survival, I think, a key part of survival is being able to measure your risk. So we design systems looking at drawdowns and such, but in real time, I think it's useful for everybody to be able to quantify. What is the risk that their group of positions is taking, and so that's what we do. And we multiple times in the day we're calculating a VAR, stress testing the system. Say there is a 3, 5, 7, 10% move intraday in the underlying, or if the IVs move by X amount plus or minus, how does that affect your positions? So that's something that I think can be useful. Of course, the old adages of leverage and position size and all those are, I think, quite normal for people to think about when they're designing their systems. Yeah, I'm done.
Thanks a lot, man. Just so to you as well as to some of the other speakers who will be coming on, like Kirit, Ankit, Anant, if you test a system and have you seen any reason? I mean, let's put it this way. Could you say that there is a period it may not work without you knowing exactly why that happens? Or is it generally very easy to pinpoint if something is not likely to work or for a period, then why is that not working? Or do you take the approach that whatever has happened in the past, there's a backtest, there is a drawdown? Well, I can go 2x this. And Ankit had shared a very interesting thread recently on this in our space as well. Do you all budget that way that, for any reason which I cannot understand or explain, I mean, I should buffer for a 2x at least, kind of maybe a drawdown or something like that?
Yeah, I'll let Ankit pitch into to that. But what I'll just add is that when anybody trading options, your backtest is just one path that the markets would have taken, and there are multiple paths that are possible even in the future. So let's take a simple example of, say, you are selling volatility and your edge lies in implied volatility being overstated to the realized volatility, right? That's the simple edge out there. So now this simple difference, I vol minus R vol, can get expressed with an innumerable number of paths that the market can take. And how your strategy or trading system handles that path that the market eventually does land up taking is going to depend on whether you're going to be able to sustain running that system or not. So in that sense, eventually the system might work, but while you get to that end state, you might be in a situation where you just can't handle the path that the market has taken. So it sometimes it's a futile exercise to keep second guessing your system and trying to think about, or your method. It doesn't matter. It doesn't have to be a systematic study. You can just be discretion, right? Where you don't know whether the localized underperformance or negative performance that you're having is eventually going to end up with how the system behaved in the past when you were testing it.
Anyone wants to follow on that? Feel free, without any specific sequence, just jump in.
Yeah, Vivek, probably I'll add something to what Prashant has just added. So, when we talk about different paths, your question was really, if our system is having an underperformance in the recent times, do we trash it, or how do we assess whether we want to continue it or not, right? So and you kind of alluded to the study I had shared on Twitter a few days ago about running these Monte Carlo simulations, and there are other simple measures as well of 2x the historical drawdown before you start contemplating whether the system is working or not. But at the same time, what we also do is, something called as P&L attribution. Um, if you are running a simple system or simple strategy, let's say a momentum or a volatility selling one, it's not too difficult to understand where your drivers of the returns are coming from. Whether a good trending day makes you money, or whether a IV crush makes you money, or whether a combination of both makes you money. Overnight risks, if you're taking, then what makes you money and what doesn't make you money. And that's usually the first indication of whether your system is broken or the markets are changing. Like for one of the systems that we run on positional trend following basis, the overnight gap risk has increased so much. The market trends in one direction, and suddenly by the time we open the next day, it's completely opposite, right? So that's where trend systems would fail a lot more. But does that mean your underlying behavior of the system has changed? Because you see, when we design system, we try and uh, improve the signal to noise ratio of the markets. We all know the markets are very noisy, as in there's very less signal in the market, and there's a lot more noise. When we design a system, what we are trying to do in a mathematical way is trying to increase that SNR ratio, signal to noise ratio, and that's why we believe our system will make money, because we are able to harness some of the patterns or some of the signals in the underlying noise of the market and make money from that. So in the scenario that we are currently facing, when the tail risks, or we know when the situation where an overnight gap can completely kill or wreck your portfolio, it's not foreseen in the prior history. It may not be seen in the same intensity, or on the same level as your back test might be. So your process of building the system, or the system that you had built, is actually still working fine. It is still kind of able to decipher the signal from the noise, but it's just the market environment has changed now. And that's where it becomes important to understand that your system is working fine, the market dynamics have changed, and if you've done the analysis, the kind of analysis Prashant was talking about, or what I had shared earlier, wherein you have that buffer to see, okay, even with my back test, the one path that my back test took, and then I ran 1,000 simulations to think about what are the other potential drawdown phases that this might have occurred. A combination of these two will kind of make you feel comfortable whether to continue or not. And with the analysis of the drawdowns, the distribution of drawdown, you can help you size your positions accordingly. So if, for example, if your backtest shows 15% drawdown, but then if you did this analysis and you come up with a 95% probability of hitting up to a 28% drawdown, then you will more likely to position size yourself according to 28 or 30% drawdown, which is also incidentally the 2x of the historical drawdown. So that helps in making sure that if your current drawdown is more than the historical drawdown, you're still able to live with it. And B, understanding whether the market dynamics are changing or the regimes are changing, and maybe that's why you're losing more, not because your system has broken down. So think of a system as a filter which takes a lot of noise and signal into it, and it outputs a stream which is more clean. So your filter is still working. It's just that what the input is coming is much more noisy or much more messy. And these are some of the tools which can help you assess that. And there's no clear answer to that. So that's what I just wanted to add to what Prashant said.
Thanks a lot, Ankit. And we have seen, like in one of these, kind of larger portfolios where there are a lot of HNI, UHNI kind of clients, they mostly prefer, they're okay with lesser return, slightly lesser, right? But they prefer totally hedged solutions, right? Where you kind of hedge your overnight risk and you maybe pay a little of insurance for it, and you can hedge it via options, and at least you're not affected by what Putin says or Putin does.
So
Um,
Vivek, I'd like to add something here on that, because I've had discussions on hedging the overnight risk if you're running an overnight position completely. And in a normal world, let's say when there were let's say this Ukraine Russia war was not there, on the global cues were not that
right.
bearish. If you constantly hedge your overnight risk, you're gonna give up most of your return. And then then comes the environment like today, wherein you should hedge at least some part of your overnight risk, which we actually also started doing. It's not a complete hedge, but it kind of hedges the extreme tails, right? So another way to think about these overnight hedges is when to put them on and when not to put them on.
Absolutely.
That itself is a system. I mean, that itself is that kind of a filter. You can't be blindly putting them on and off, and then that's where a lot of these edges may lie, that you can decipher when they would be helpful and when they would not be.
Right, absolutely. So when you're generally doing any single strategy, then it doesn't make sense to hedge all the time because it's very expensive. But probably if it's a smaller portion of your total portfolio, which is direction, and you hedge, you may want to hedge that and see interesting results there. Probably moving on to Anant or Kirit, any one of you may want to take up, and then we can have Param go on later. Yeah, thanks, Kirit.
Yeah, thanks Vivek for inviting. We are more into stocks, not at all into options. I think most of the interesting points were covered by Prashant and Ankit. I would just like to add a couple of points because even I've developed a couple of systems over the past few years. Uh, the conclusion that I've arrived is, markets go through infinite number of permutations and combinations. Now, it is practically next to impossible to factor in all the permutation and combination. So let's say if you have a strategy where it says A plus B equals to C is entry and X minus Y equals to Z is the exit. If and when the market goes through that particular process or that particular pattern, that is when the effectivity will actually work. Now, what percentage it contributes is a question mark. Secondly, every system goes through a losing streak. Okay. So it's trying to adjust your system just because things are being changed. So if you let's say the volatility is shot through the roof right now. But that's what markets are supposed to do. What if you're on the right side of the volatility? You tend to benefit a lot. Okay. Also, the second part where majority of them go wrong is everybody talks of risk management, but they seldom apply risk management.
That's a good one.
Yeah, thank you. Seldom apply. I run a program, Vivek, you are aware, and I was appalled to know that when I asked what is the value of one, the R that you take, they had no clue about the R. I think the biggest misconception is stop loss Bhagwan hai because they assign it a rupee value. So, for example, the current ATR of Nifty is about 300 points. If you let's say you short a particular trade or you go long and you keep let's say 50 rupees stop loss, that's what an average trader does. And if the trade goes in your favor, 100 points. So you calculate, okay, fine, I am sitting on 100 points profit. My stop is 50 points away, that's 150 points. So I might as well carry the position overnight. Now, if the ATR is about 300 points, why it cannot open 300 points down? It's quite likely, right? Because you feel money allocation will do the trick, it's not going to work. So I've never ever hedged, and so have my mentees and some of my investors. But what I do at times is during such volatile time, I would probably prefer to look back and see, okay, what has been the worst case scenario? So probably I may adjust my volatility and my risk and my position sizing based on the worst case scenario, which will lead to lesser number of shares. But at the end of the day, I know, it still can be broken. And I think lastly, the biggest problem is having an expectation. Majority of the people I've seen, I think. Well, that's where the problem actually starts. Why build an expectation? We have no control over the outcome. The outcome is a question mark. It's the risk that is in your control. And even if you design the best of system, the challenge is when the system goes through whipsaw. You made a very interesting point. Drawdowns, जिसको नहीं होते, that gentleman is lying, which is so true. I think on an average Nifty system, even the good systems I've seen, 25, 28 is the norm. You will go through that phase, no matter whatever you do. But the recovery time is also much faster. And you need to be a bit of flexible with zero expectation. Let the market do. Who knows? Who would have thought 3 days back that we rally 1,000 points? Now looking back, everybody would say, as neither of us says, that a rise or fall was coming was known to everybody post the event. But we trade in live market. And why is it that we always want to be right? If you see the best of traders, whether it is RJ, whether it is Soros or Ray Dalio, they've gone right just about 35% of the time. How many? Okay, even on a day when the market bottomed and when I saw some of the tweets saying, oh, I entered at 15.8, 15.9, how many of them would have held Vivek till today? You know the answer, even I know the answer.
Kid, what is one of the thing? Absolutely, totally, I can tell you. If in 2020 when crude was negative, if somebody said ये $120 या 130 हो जाएगा एक डेढ़ साल, that is something which totally is something I know.
No, majority are, I think the biggest time is, MBT. But actually, how many of them have made the trade? I mean, it was a easy going. Trend following is a tough time, but even if you would have bought at the close or day before yesterday, I didn't take that long trade. Huh? Let me be honest about it. I missed the trade, but I didn't take it. Let me be very honest. So you just have to follow the trend, and you could have easily made a 700 points ride. And also, what I find appalling is every time the market goes up, with 500 points ka move aa gaya, we find it too overvalued. Now, when the market corrects, as if the world is going to end, that's something, which is beyond my reckoning. And we have to get one thing very clear: nobody knows what's going to happen next. You may be lucky in the short run, but in the long run, nobody can predict the market. That's what I want to add, Vivek. Thanks for giving me a chance to speak.
Thanks. A very interesting perspective. In fact, and you can see two dimensions of traders, like some option traders, some you believe in hedge, some don't hedge. Kirit is using pure equities and he has a lot of experience in psychology and mechanics of system trading, I would say. And he adjusts, he doesn't hedge, but he tackles the problem by reducing size. So everyone has their own way. Anant, would you like to add something?
Yes, I would, because see, a lot of people. Let me put it this way. Thanks, Vivek, for asking the question and letting me speak. But the market is doing nothing unusual. I am surprised why everyone's talking about it being unusual. We had a long period of low walls.
Dani,
Market moving up nicely, and then the market started correcting. Now everyone is talking about systems and the methods and all of that, but we got to understand one basic thing: market has different phases of expression, and during these phases of expression, a system which will work in one phase will not work. So it is an intelligent trader or an intelligent analyst who would understand what phase the market is in and modify his systems or choose a different system which is best suited for this phase of the market. Someone wants to ask a question in between? Okay. All right. Now coming back to the rally yesterday and today, and what has happened. See, if you see the first rally that the Nifty did while correcting down this one was 1,000 points. Today we did the same 1,000 points, and we started dropping down. That is classic basics of technical analysis. Why are we missing all of that? It is because we have not been paying attention to the basics, but looking at something which is way beyond what we truly understand. If you had understood what, why, and how this is a system has been developed and the logic behind it, you would understand instinctively which phase of the market you would use it in. Now, there are many ways to look at this market. See, the basic one would be just market is doing lower bottoms and lower tops. Why are we just not looking at it and calling that this is a declining market? Why are people only looking at market going up? True, I understand at one point that majority of the traders want a bullish market, but market is not going to listen to you and I. It has its own way and it is own method. That is all. Actually, I saw Deepak Shanoy also, so I thought I will listen to him. So, but I see Deepak Shanoy is gone. So, anyway,
Yeah,
those are the just two points I had to make.
yeah, I
Thanks.
saw Deepak too, but I think we couldn't count him on. Param, you have a great story to tell. We'll be very happy to hear your story for the day. Thanks, Anant.
Well, first, good evening to everyone here. Like you all are like my seniors, and I've definitely learned something here and there from each one of you. Am I audible, Vivek sir?
Sir, you're totally audible, sir.
अरे आप सर मत बोलो. So, and brief introduction about myself. I'm primarily an option seller, completely on discretion, and there are some rules built in within myself. And like obviously, I don't have an algo or like a back test or something like that. I just go on with it. So I was like just sharing my like today's experience with Vivek sir, and what Kirit sir said today about like not having a hedge. So I sell options naked completely. I sell straddles, multiple of them. And for example, today I had 300 lots sold on Bank Nifty alone. And in the morning, I opened around 1.5 CR negative, which was like 25% of the capital which I deployed. Of like around 5 CR, like 1.5 CR was gone. Vivek sir has all the details and stuff. And how I trade personally is that if like what I would also recommend, like if you are selling options and you don't want to buy and hedge, obviously because it eats up a lot of premium, especially in high VIX environment. Like even yesterday, the 14,300 350 PE was trading around 15 rupees. So you can just imagine what the near at the monies were trading to if you want to hedge a straddle, and not to just say a hedge that okay, we are hedging 500,000, 1,500 points away. That's just you are buying leverage for the margin benefit at a cost. So I don't usually hedge, and my thumb rule has been that I always am prepared for lower circuit. That okay, what if the lower circuit gets hit? What will happen then? Let's say Bank Nifty tanks 4,000 points tomorrow morning in the open. How much will I lose? So I allocate my capital for selling options accordingly to that. Now, let's say if I have 50 CR and I am ready to deploy 5 CR upon it, and then I know that okay, if let's say tomorrow the lower circuit gets hit, then I know that okay, I will lose 5 CR. So that's my, and like if you want to say drawdown on the overall capital, it would be 10%. And obviously, returns are not that high as well, but like even a 2% return is favorable if you're selling options. And we all know that yes, options do decay. And let's say Bank Nifty in a year alone gives you more points selling straddles if you sell them every hour and every 30 minutes than the whole value of Bank Nifty is sell like more than 30, 40,000 points alone easily. So in my today's experience, like I would say that I was down 25% on the allocated capital to the strategy. And then like I went bullish then. That okay, let's go bullish. And then I was playing with the next week expiries as well. So that to just gain some premium because today was the expiry and I would not have that much premium left. And plus it was also an event day. So how I trade the markets, and I would agree that okay, these are unusual markets. This is not our everyday business because especially due to the gap ups and the gap downs, it does not matter what happens during the day, and I think that everyone here would agree with it. We can control what's in the day, like someone said right now that about stop loss, 100 points target, 50 points stop loss, that we can do. But main problem comes especially, let's say, for an option seller, like people who sell naked options, or even those with hedge. The main enemy of on these days have been the gap ups and the gap downs. I think that all would agree to it, Vivek sir. Even your strategies are deployed.
Yeah, I think it's interesting because we have seen gap ups and gap downs over the years. And I think what is also very interesting, I remember what Anand said one of the time is that why are we all saying it's unusual? Because we have seen with a low wall, it will not remain low forever. There will be reversion, right? And a high
Yes.
wall like what we are seeing now may remain for a while, but it's not going to remain forever. I mean, that's the
Exactly.
whole interesting part about how you deal with this. And then how you kind of manage your size and how you deal with the risk is, I think, what finally can ensure survival, right? So it's
Yes.
extremely
Ye-
important to do that.
Yes, and like even today, like I barely managed to escape like flat, like 8 lakhs in the positive in the end, but that would all go into charges and brokerage. But the main point that, and like I also like even today I bought options, which is like really unusual for me because in the next week the options were not decaying even for the strangles. So I was like, okay, and honestly, I don't like I know that all of you guys here and like my seniors and like have been in the market since I was born, but I don't personally look at charts
There are
and
no
I don't.
seniors. Parang, there are no seniors. We all are just we all are surviving, right? And we trade a
Mm,
method. But I'm
no, but like
curious to know those in your trading. Do you have some basic rules? Like you said, you have some rules, right? And always there is this
yes,
debate
like
of discretionary versus systematic.
yes,
So,
yes,
can you throw little light on your rules
yes.
also?
So like Vivek, so like when we met, I had like told like I don't look at the charts while selling. Am I audible?
Yeah, yeah, you are.
So like you know that like I do not look at the charts while trading. I don't look at the OI data, and I don't basically look at the mainly where the Greeks are, where the IVs are. I consider that okay, my work is to sell options. I want to collect premium, and I want Nifty to be in my range. And like I'm completely non-directional trader, not even directional option selling. That is intraday. That's separate. But like for non-directional, I look at the premiums basically. And my thumb rule is that, and like my basic psychology with everything is I'm a completely non-directional person, and as well as a contrarian at heart. I'm not a trend trader by heart because I have never been just able to. So in my like what you said, what discretion plus system. So like my rule is first is that at any given day, if a lower circuit of 10% gets hit, my overall capital should not be hurt more than 10%. That way, what will happen is, let's say that we hit low circuit, where will the India VIX and the premiums will be? It won't take me, and like you all have seen where the premiums shoot up due when the lower circuit gets it, or like in a really highly volatile zone. If let's say the India VIX is above 30, 40, 50, there is enough premium for me to just manage by just 2 or 3 straddles in Bank Nifty to cover a move of 15 to like 17%. And at that point, my psychology is that okay, I will infuse more capital. Let's say I'm infusing 5 right now, then and if all gets blown up, it's okay. It's a 10% drawdown. I think that as an option seller on a lower circuit day, like that's the worst case scenario. Like it is just opening lower circuit, and they're in the money. So obviously IVs won't matter to them. So it's just pure future. So my psychology directly comes that okay, boss, itna ho sakta hai. My second thing, let's say on like markets like current situation, that is extreme. My second thing is that I should not be giving any straddle more than 3 to 4 times the premium that I have collected on it. Because if I have, then there is a 90% chance that okay, my midpoint for the straddle or like even the range would not be collected until unless the VIX is of 35 or 40, and I'm getting a premium of 2500 to 3000 rupees per straddle. So that is the second rule. Third rule is that I should be always, this is what I call dancing with the markets. Like jahan market wahan hum. Because as a non-directional player who's playing straddles, like not strangles, our goal is basically to be as near as the midpoint of our straddles as possible. So these three basic rules are there, and over the time, like it's like कहते हैं ना कि रगों में बस जाती है. So these things have been like just in the hands now, and it's like a few basic things like okay, let's say Bank Nifty goes up 1,000 points intraday. I won't be cutting down my straddle, which is below 1,200 or 1,300 points. Like even today, I was carrying 32,300 straddle, which gave me a majority of the loss. The call gave me, and there was nothing in the put left. So these are the few basic thumb rules, and I also play upon premiums. If I'm playing on strangles, I would want my premiums to be matched. So the delta can be basically neutral, and obviously we like even in the current scenarios, I would say that an up move will kill more people than the down move because people are afraid to sell puts even intraday or position, but people are not afraid
Yeah.
to sell calls because they think कि okay कुछ बुरा हो जाएगा नीचे चला जाएगा calls अगर बेच भी दिया तो portfolio बढ़ जाएगा ये होगा वो होगा, but calls have a relatively lesser IV and they will spike much faster, much harder, and you won't get a time to exit. Like most of the people won't, apart from obviously rule based traders, they won't be able to make a decision that okay now I have to exit. Like even I believe that more people lost money today and yesterday than they did in most of the gap downs or while the market was falling. It's because during times like these everyone gets afraid okay bazaar toot raha hai, bazaar pani ho gaya ye, so the market is falling, but at the end of the day no one is really prepared. Okay, what will happen if the bank nifty goes up like it shot up right now, like yesterday, today? I don't think that majority of the people were ready for that. Everyone had made up their mind that okay, we have broken the weekly support, we are under the 200 DMA or etc etc. The RSI is going down, it has got out of the overbought zone. Like any excuse that you would want to make to not able to like kill your darlings. So the second rule is also this, that whenever the market is falling, I always make sure that my calls are far above, far above. Because I know personally that the puts won't decay if it's not a Wednesday or Thursday that much. They would go overnight like it has been these days. Like even during these days, the people who sell straddles intraday haven't been able to make much of a profit if it's not a Thursday or a Wednesday. Why? Because all the IVs gets crushed in the morning itself or late in the afternoon. And intraday, the moves just takes their stop loss or anything. So I do believe that okay, like even if you like buy an option, and if the market does not like if you're an option buyer, you would want a really good news or a bad news to come. If you're an option seller, you would want ki let the world go on as it is. But we all know that okay, like both cannot survive at once. Even if you're selling options or doing any kind of your strategy and buying some insurance upon it, you will be losing money in the long term. Like that is statistically proven, that is just data. So I would say that controlling your position and knowing what's the worst case is the way to go until and unless you personally feel comfortable, because there can be any number of drawdowns or like returns on paper, but following through that, I think that only 1 in 100 people can do that. I even know like many PMSs and companies who like manage funds of like ultra HNI peoples and stuff, they have stopped following the system because they just cannot. And like that fear does sink in. So anyone here who's like not like a pure system based trader or like doesn't or like is confused, like considering that okay these are unusual markets, I would say that managing a position is the biggest thing that you can do to yourself. Like that's the biggest favor. Buying a put will be is just like insurance. The reason why they're selling it. Okay, you might get lucky, you might hit a lower circuit. But in the long term, if you just manage a position enough, there is enough money in the market for you to churn if you do it slowly and slowly and slowly. So it's just like
So
yes.
thanks a lot, Param. I think you hit the hammer on the nail. Eventually, saying it's boiling down to the position size, and everyone has
Yes.
their own different risk appetite and tolerances. So I would love to request Karthik to
Hey,
share some ideas on.
Vivek,
Yeah, Prashant, you want to add?
I have a very
Please.
quick question for Param.
Yes, sir.
Param, you mentioned about at the very end. You mentioned about managing your position, right, and adjustments that you might do. Have you, through your trade logs, looked at the PNL of your strategy by itself versus the PNL of the adjustments you've made? Have you done any analysis around that?
So I have, like I said, like just 3 basic fixed rules, and I don't have a system per se, like a proper algo based or something. I manually punch my orders. I just look at the price of the spot in the future, Bank Nifty, and India VIX, and I would say that obviously the returns have been there because when you place all your capital on risk and sell naked straddles every single day of the year, the returns are there, but again those returns get shadowed down because on your overall capital the amount you're risking is low. So I would say that adjustments are there and I don't have any such other thing to refer to it. So, because like I'm a discretionary trader, my PNL is my only back test, I would say.
Okay, thanks. Yep.
Thanks. Can we have Karthik share some thoughts on long only portfolios in regime like this? If you're still around, Karthik, and
Yeah, hi Vivek. So yeah, I do both long only portfolios and options. So, but my options are very limited. My long only portfolios, are basically based on what Ankit has shared. So it's mostly to do with like Monte Carlo simulation, so that like like what is the kind of loss. You kind of see like. When there is an extreme event in an market. So you have a fair number to know that like yeah, my portfolio might be down by 2.5%. So we use quantitative methods and try to beat this number so that like our portfolio doesn't see much of the risk. So talking about options, uh, some of the things like which help me in this volatile period is like yeah, the period is volatile. So one thing is for sure, the VIX is really high. So around more than 25 levels right now. So which means that there is more volatility in the market. So the prices are not going to stay at the same level for a longer period of time. So having said this, like we can actually look at limited risk strategies, like which involves like 3-legged and 4-legged option strategies in such an environment rather than just doing naked option buying or selling. So one thing which helps a lot is I'm not taking any overnight positions. So whatever I'm doing is like a purely intraday because I feel overnight is too much risky because now the market movements are mostly based on news and not, common sense or whatever it is. So one thing which helped me is this one overnight risk. I do not take it, and other one is like I use limited risk strategies. So we can look at call ratio back spreads, put ratio back spreads, so that like you always know what is the maximum loss like you'll see in your option strategy rather than just doing say um, naked buying or naked selling, so which I usually don't do.
great. Thank you, Karthik. Thanks a lot. I think we will just have time for Amit Goel to speak before you wrap up. Actually, it started off with a discussion where Amit said, "Why don't we just come on and do a Twitter space and share what we're going through?" So, Amit, please share your thoughts and then we can wrap up.
Hi everyone, good evening. Am I audible?
Loud and clear.
All right, thank you so much. So this is the vote of thanks because I am a novice trader and I don't think I'm qualified enough to speak in this August gathering. So I thank Vivek and everybody else that who have come here and shared their thoughts.
So I think
Now,
Amit, experience as a trader is indirectly proportional to how expert you think you are, right? I mean,
all right. So couple of quick thoughts. I don't want to. मेरे पास ज़्यादा है नहीं कुछ बोलने के लिए. So I'll quickly say what I do, and maybe if somebody can take a couple of pointers from there, great. Or if somebody can point out कि यार तू बेवकूफ़ी कर रहा है तो ऐसे मत कर, then I'll be obliged. So here we go. What I do is I don't do intraday. I'm not a systematic, I'm not an algorithm trader. So somebody pointed out, somebody in the sense, Vivek Bhai pointed out that, boss, you are an systematic trader. You're not an algorithm trader. As in, you have not coded your system, but you follow a system. So now I have started calling myself systematic trader. I do mainly non-directional or delta neutral strategies, be it long gamma, be it short gamma, or long ball, short ball. I also have started exploring the world of buying options for in stocks, which has yielded some decent results. The way I do is this: I do positional trading. I use technical analysis. I have a setup. So I'm also a CMT level 2 candidate, and I like implementing what I'm learning. So I feel that it gives me comfort in the trades that I take. It gives me the confidence that I'm taking a trade basis some logic, which is given on the price chart. I do have subscription to Economic Times, which I don't read. घर पे आता है रद्दी वाला लेके जाता है. I kind of have stopped reading. So my background is that I have about 18 years of market experience. I'm formerly a equity fundamental equity research analyst. I've worked with some of the top mutual fund companies. I used to track the banking BFSI space, the banking, financial sector, and insurance space, as a buy side analyst. So that's my background. So coming to my trading style, I do a lot of positional trading, mainly options. I have a cash component, long only portfolio, which I generally invest in Nifty Bs. Coming from the mutual fund industry, I kind of have a insider's perspective about the portfolio management systems and everything. So I believe it's the lesser of the evils to invest in an index like a Nifty Bs, which has a survivorship bias. So I need to survive. So the motto of this game is you need to survive long enough to enable the market to bless you with the profits, bless you with the money. If you burn your candle on both the ends, you will not. So I play the long game. In the sense, I do not do intradays. I don't take views on 1 or 2 days. I don't do these 920 straddles. I don't know how to manage that kind of volatility. It's too much noise for me, and I'm a kind of a lazy guy who does not want to get into so much of management of trades. So I do positional. I mainly like doing the monthly options, and even the leaps, the long calendars and the long diagonals. I kind of, I think I excel in those calendars and diagonals, which is essentially the staple diet for a lot of prop books, a lot of hedge funds, a lot of people who have a longish view on the market. Right. So in terms of that's the way I trade. I point number one is I take a view basis technical analysis. Once I form a view, I understand what are my if it is a non-directional view. See, what I believe is markets trend, and they trend in a mean reverting fashion. As in, when I say trend, there is a slope of the price action, right? The slope can be upward facing, or it could be downward facing most of the times. And even in that slope, there will be these zigzag movements. There will be this up and down, these troughs and peaks, which is basically the mean reverting nature of the trend, right? So one needs to understand this. One can't just say I am a mean reverting or a contrarian player, or I am a trend following player only. One needs to understand that the market price action is going to be a combination of both of these. It's going to have a slope, the momentum, and it is going to be mean reverting inside of that slope. Right? You pick out any chart, you will not find a straight linear line. You will find these zigzags. So one needs, so the shorter the duration of your trades, like an intraday or a 1 day or a 2 day or a weekly, probably there will be chances of hitting those whipsaws, right? Which takes you out of the trade. But if you are in the game for a longer time and you allow the market, you respect the market's volatility, which is again, like Kirit Bhai said, uh, great respect to Prashant sir, Kirit Bhai, Ankit. I keep, it's a constant learning process with you guys. So thank you so much for sharing your intelligence, your knowledge about the market. Uh, Now coming back to this, so Kirit Bhai said that it is about the ATR. So people don't understand that, right? Nobody actually bothers that the current ATR of Nifty is 360, 367 points. So one needs to appreciate that. You can't have a 150 rupees ka straddle in this kind of a market. You will be killed. So I'd rather, when the volatility is higher, I'd rather go longer. I'd rather go wider. I'd rather go further from the expiry and set up my strangles, straddles, or diagonals and calendars and manage them. I love doing. There is another concept that I follow, which is irrespective of what the current IV is, what is my expectation of the IV? In the sense, while the IV currently is high, I'll give you a case in point. Maybe that will throw some light on the way I trade. It might be good, it might not be good. So just help me out on that. अभी क्या हुआ, मैंने recently एक put diagonal spread bank nifty में plan किया because I had a net bearish to neutral bias on the market. This was a week back. A week back, and I had set it up for the monthly expiry. And I had expected that there will be a downward bias, and in spite of the high prevailing IV environment right now, I expected that the IVs will probably continue to be high or maybe inch up further. So that was the play, right? So my expectation of IV was that it is going to inch up from the current levels also. So in such a way, in such a scenario, I wanted a Vega positive trade, which a diagonal provides me, including also giving me a theta positive benefit. So theta भी मिलता है, Vega भी मिलता है, बल्ले बल्ले. So मैंने क्या किया, put diagonal spread plan किया, and markets crashed. Markets continue to crash, and it crashed nicely. It went. What happened was my entire trades break-evens, expanded because of the expansion in volatility, which allowed. See, in a diagonal, the break-evens are fungible. They are dynamic in nature. With increase in volatility, the break-evens widen. So that gave me more room to breathe. मेरे को suffocate नहीं किया, मेरा SL hit नहीं हुआ. Okay, and after that there was this reversion of the price action. ठीक है, it reverted, and market today closed at bank nifty. My short unit input was 34,800. The long was 35,000. Okay, both the puts. Market went very close to 34,800, and I made about, I don't know if I should be sharing this or not, but yeah, I mean, just to explain, I made about 20% ROI on this trade within a week, and this was a monthly trade. But since I made my target well within time, I exited it. Right. So the expectation of volatility is one which I play on, and I like to stay away from the noise and have a broader view of the market. And without technical analysis, I cannot put on a trade. I am fully aware of the Greeks. I am a great student of the market. I keep reading about Greeks and falana, declana, everything. But मेरे को बिना एक view बनाए हुए, I cannot simply take even a non-directional view में in a trade, which is my bread and butter. I still have a bias, and I manage that bias by having, say, if I want to put up a iron condor or a iron butterfly, I would, if I have a bearish view, right, I would probably have a broken wing iron condor or a butterfly, which is giving me greater protection on the put side, on the downside, right? Now in calendars and diagonals, which is my staple, so whenever this is a thing that I do, so whenever I hit my break evens in spite of all expansion or whatever, I simply put on another calendar or a diagonal and convert it into a double. So what that does is that gives me that simply expands my range, and it allows me to look to get out at least in a break even. So in a managed trade, I try to get out at a break even point rather than trying to achieve my target. Okay, so I guess यही था मेरे पास बोलने के लिए. If there is anything specific.
So, Amit, would you say in the recent times, other than position size, your methods are more or less just the same, or any changes you've made in your approach in the recent volatility regime?
So I see, the point is this: after 18 years in the market, one understands that this is part and parcel of the market. I mean, people who have started trading in the last 2-3 years may or may not have seen the volatile markets of 2007, 2008, which I'm sure you would be aware of. ये volatility कुछ भी नहीं है उसके सामने, right? On a lower base, having much more volatility and a frustratingly long period of falling prices. अभी क्या होता है, 2 दिन में गिरता है मार्केट, तीसरे दिन बढ़ जाता है, इररेस्पेक्टिव ऑफ वॉर, वर्ल्ड वॉर 3 बोल रहे हैं, पुतिन कुछ बोल रहा है, 3 दिन के बाद मार्केट भाग जाता है, राइट? हम लोगों ने इसीलिए वो इट्स इजियर दैट वे कि भाई गिरा है, ठीक है, वो वापस भी आ जाएगा. बट इन टर्म्स ऑफ व्हेन यू, okay, I think I'm digressing. So what I'm saying is, I do not really change my position size that much, but I always calculate manually what is my total risk I'm carrying on my books, right? So irrespective of the volatility in the market or whatever, irrespective of that, मुझे आज अगर आप पूछोगे, I can open my Excel sheet and tell you रुपया ना पैसा what's my max risk, okay, the theoretical max risk जो होता है ना, एक बुल पुट स्प्रेड प्लान करते हो या बेयर पुट प्लान करते हो, there is a max risk which happens and there is a risk at stop loss. So I have both the figures in mind, right? While I position size as per my SL risk, but I am always aware कि अगर लगनी होगी तो मेरी कितनी लग सकती है.
And what is that number generally you work with?
About I used to carry 2% on my capital, on the overall capital and not on the margin. I mean, a lot of people do that mistake. But after spending time with you, I have reduced that to 1%. I'm trying to reduce it further. So you have taught me that, even 2% is pretty high. So now I don't carry a risk of more than 1% on my books. That's the risk at SL. So my position sizing is guided by the risk I'm allowed to take. So अगर risk मेरे पास अभी gap है, अगर से ₹1,00,000 का risk मैं carry कर सकता हूँ, 60,000 का risk मेरे पास already है, तो मेरे पास 40,000 का और खेला बाकी है. So I will probably look for trades, and if I find that it is answering my setup, I'll take a small bet there.
So I think this is one consistent theme we have seen across many different types of traders who spoke today. Prashant, Ankit, Kirit, Anand, and Param, and also over the last few days we've been talking to. End of the day, everyone has their own sort of you can say stomach, right? And the number is different for everyone because we are all not the same in that sense. Intellect is different and stomach and gut is different, and trading is actually from the gut, right? And not from the intellect. So I think with that we would like to thank everyone. Thanks all speakers for spending time, and recording of this is going to be available, so we'll try to just post it back, and let's keep having these conversations and sharing whatever you feel. Don't keep it inside, express it out. That's, I think, the best way to live and survive. Thanks everyone.
Thank you Vivek ji.